Is it a good time to make that gold or silver purchase that you have been eyeing during the festive season or beyond? And why have gold and silver prices been falling?
The dramatic swings in global financial markets over the past few months have been difficult to ignore. But for some of the most extreme volatility in recent memory, attention has focused on the precious metals market, and in particular, on an extraordinary collapse in silver prices at the end of January. On January 30th, the price of silver suffered its largest one-day fall since March 1980, plunging by 27% in a single session. Gold, often viewed as silver's more stable counterpart, was not spared. It recorded its steepest one-day decline since the early 1980s, falling by 9%. The scale and speed of the sell-off stunned investors, especially given the strength of the rally that had preceded it. Even after that sharp reversal, silver remains roughly 50% higher than it was at the start of December, while gold is still up around 16% over the same period. The intensity of the fall, matched only by the ferocity of the earlier surge, has prompted a heated debate about what or who is responsible for the violent price swings. In the immediate aftermath of the sell-off, attention quickly turned toward Asia. Market commentary widely pointed to Asian retail investors, particularly in China, as the primary drivers of both the rally and the subsequent collapse. Record inflows into precious metal-backed exchange-traded funds, rising levels of margin debt, and the growing participation of individual investors across the region were cited as evidence that speculative excess in Asia had destabilized the market. However, a closer examination of the events outlined in this report suggests a different interpretation. Rather than being the root cause of the volatility, Asian investment flows appear to have amplified a market already destabilized by a much broader force: global uncertainty tied to political developments in the United States, and in particular to the return of Donald Trump to the White House. The report argues that the recent boom in precious metals cannot be understood in isolation. It unfolded against a backdrop of mounting concern over the long-term stability of traditional safe assets, including the U.S. dollar and U.S. Treasury bonds. Since President Trump returned to office, many investors have become increasingly uneasy about what the article describes as the debasement of mainstream assets. Those concerns have been driven by several overlapping factors. Hefty fiscal stimulus in advanced economies has raised questions about debt sustainability. Persistent inflation risks have eroded confidence in fixed income assets. At the same time, worries about the erosion of governance standards and institutional autonomy in the United States have added to a sense of unease about the foundations of the world's largest capital market. In this environment, precious metals, particularly gold, have regained appeal as a hedge and a diversifier. For investors seeking protection against uncertainty in currencies, bonds, and political institutions, gold has once again been viewed as a store of value outside the traditional financial system. Silver, closely linked to gold in investor sentiment, benefited from the same dynamics. The report notes that this so-called debasement trade gained momentum as uncertainty intensified. But that trade began to unravel abruptly following a key political signal. When President Trump announced his intention to nominate Kevin Warsh to chair the U.S. Federal Reserve, investor perceptions shifted. Warsh, a former Federal Reserve governor, is widely regarded as less tolerant of inflation than some of his potential counterparts. According to the article, the announcement reassured many investors that monetary policy might not remain as accommodative as previously feared. As confidence in tighter inflation control grew, the logic underpinning the debasement trade weakened. That shift in expectations proved enough to trigger a fierce sell-off in precious metals, particularly given how far prices had already risen in recent months. But while the Warsh announcement acted as a catalyst, the report stresses that it was not the only force at work. The surge in gold and silver prices had been magnified by highly leveraged positions. A significant share of the borrowed funds used to chase the rally originated in Asia, especially China, which has emerged as the world's largest buyer of gold in recent years and, by extension, a major influence on pricing dynamics. Asian investors poured record sums into precious metal-backed exchange-traded funds during the rally. According to Bloomberg data cited in the article, China-listed funds recorded their largest inflows on record last month. As enthusiasm intensified globally, the total value of margin debt used to purchase securities climbed to multi-decade highs. When prices reversed sharply, those leveraged positions became a source of fragility. Falling prices triggered margin calls, forcing investors to liquidate assets across their portfolios in order to meet collateral requirements. The result was widespread, indiscriminate selling that further amplified price declines. This dynamic underscored a broader shift in market structure, the growing influence of individual investors. In its latest quarterly review published last December, the Bank for International Settlements warned that speculative activity by retail investors was contributing to bubbles in both gold and U.S. equities. The BIS cautioned that while retail inflows had helped offset institutional outflows, their increasing prominence could pose risks to market stability. Retail investors, the report noted, tend to engage in herd-like behavior, amplifying price swings when forced selling occurs. Asia, more than any other region, has experienced a rapid financialization of household savings over the past decade. Although cash and bank deposits still account for a large share of savings, households across the region have steadily increased allocations to capital markets. According to data from HSBC cited in the article, total assets under management in Asia more than doubled between 2016 and 2024, reaching $22 trillion US. Mainland China has overtaken Japan as the region's largest exchange-traded fund market, while Taiwan has emerged as the fastest-growing market for ETFs focused on domestic stocks. In South Korea, retail investors bought a record volume of U.S. equities last year, pushing margin debt to an all-time high. HSBC observed that as Asian economies have grown wealthier, households have increasingly favored mutual funds and insurance products over traditional forms of saving, such as jewelry, gold, or automobiles. Despite these trends, the report argues that the idea of Asian retail investors acting as the primary drivers of precious metal volatility is misguided. Speculative excess in Asian markets, it notes, needs to be placed in context. While margin debt on China's stock exchanges stands at record levels in absolute terms, newly added leverage as a share of daily turnover remains well below the levels seen during the debt-fueled equity bubble of 2015. Moreover, the financialization of savings in Asia has helped deepen domestic capital markets at a time when reliance on foreign capital has become a growing vulnerability. HSBC described this shift as part of a broader Asia buys Asia trend, which it said has strengthened the region's financial resilience and reduced dependence on external funding. From this perspective, Asian investment flows are portrayed not as destabilizing forces, but as structural developments reshaping regional markets. The report further argues that the surge in precious metals has been supported by powerful tailwinds beyond speculative behavior. While it challenges the logic of the debasement trade, noting that bond yields would likely be much higher if investors truly feared runaway inflation, it acknowledges the abundance of economic, financial, and geopolitical risks facing the global economy. JP Morgan, which remains bullish on gold, described the metal as a dynamic and multifaceted portfolio hedge that continues to attract diversification flows. The report also points out that the U.S. dollar index has fallen by more than 10% since the beginning of last year, reinforcing incentives for investors to seek alternatives. Against this backdrop, the article argues that President Trump's actions have played a central role in undermining confidence. His assault on the global trading system, it says, has chipped away at the foundations of stability in the world's largest economy and capital market, providing further motivation for investors to diversify into gold. Asian retail investors, particularly in China, have undeniably contributed to the speculative frenzy in precious metals. But as gold and silver prices resume their upward trajectory, the report suggests that the deeper driver of the rally, pervasive uncertainty, is becoming increasingly apparent. That uncertainty has also manifested in China's domestic gold market. In recent weeks, turbulence has spread through Xubei, the southern Chinese city regarded as the heart of the country's private gold trade. Following the sudden collapse of a major gold trading platform, a second retail-focused operator has faced a run, raising fears of contagion. The platform, WIT007, reported that it had experienced 3 severe runs in recent days amid mounting industry panic. It also acknowledged a significant funding shortfall, according to Chengdu.cn, which is affiliated with the Chengdu Municipal Government's media office. Since Saturday, investors from several provinces have traveled to WIT007's offices in Xubei to demand immediate payouts. The turmoil followed a redemption crisis at another online metals trading platform, JWR, and coincided with heightened global volatility in gold and silver prices. Authorities in Shenzhen's Luohu district announced that a task force would investigate abnormal business operations at JWR, where unpaid funds could exceed 10 billion yuan, based on investor estimates reported by mainland media. Xubei's stability has long been viewed as a barometer for China's gold industry, given its central role in wholesale trading, processing, and pricing. WIT007's business model closely resembled that of JWR, offering high-leverage virtual gold trades with low-margin deposits. The company said it had previously managed risk by hedging on other platforms, but faced severe cash flow pressure after those channels were blocked. Similar platforms operate in a regulatory gray area between physical gold trading and financial derivatives, fueling concerns among investors. Several privately run online platforms have been suspended since JWR's crisis, according to the Chinese media outlet Jiemian. Legal experts warned that the impact of these disruptions on households should not be underestimated. A Guangzhou-based lawyer, Deng Ping, said recent sharp declines in precious metals had affected numerous retail investors and their families, with some facing debt pressures. Chinese authorities had previously cautioned retail investors about the risks of chasing the gold rally. In October, the Shenzhen Gold and Jewelry Association issued an alert warning that some suppliers posing as legitimate traders were in fact running non-physical gold betting schemes, which authorities suspected amounted to illegal gambling. Adding to the strain on China's financial sector, the article also notes the sudden death of a senior fund manager in Shanghai. Shen Xianbing, a founding partner of the private fund Qilin Investment, died on Monday at the age of 40. The company did not disclose the cause of death. Shen, a graduate of the University of Science and Technology of China, had served as a founding partner at the firm since 2015. Qilin Investment manages more than 28 billion yuan in assets. His death is the latest in a series of similar cases that have heightened concern about stress and overwork within China's finance industry. Taken together, the events described in this report paint a picture of a market shaped by leverage, uncertainty, and shifting investor behavior. While Asian investors have played a visible role in recent price movements, the article argues that the deeper source of volatility lies elsewhere, in the global uncertainty triggered by political and institutional developments in the United States. What remains clear is that the forces driving gold and silver markets are complex, intertwined, and still unfolding. The report concludes that as precious metals continue to rise, the underlying cause of the rally, pervasive uncertainty, is likely to become even more evident.